Hello and welcome. I'm Meredith Rosen, Director of Client Experience at Bedell Frazier Investment Counseling, and it's my pleasure to welcome you today to our 2022 Market Outlook. This is our second year of having a virtual Market Outlook event with you, and we really had hoped we'd be able to do this in person, but given the current guidelines and guidance here locally, we find ourselves virtual again. We really look forward to being able to be in person with you later on this year. But we continue to embrace the silver linings of a virtual event, which allows us to have over 120 participants from across the country joining us this afternoon. So thank you so much for taking time out of your schedules to be with us. It's been almost 2 years since we were last all together. So I wanted to take a moment to introduce our team. We have some new clients who haven't been able to meet all of our team members face to face yet. And since it has been a while for all of us, I thought this would be a great opportunity to just go over all of our team with you. Here's our team at some of our get-togethers this year when we were able to be in person in 2021. First, I want to introduce Mike Frazier, our president and CEO, who you're all very familiar with. Mike is focused on client communications at a very high level through the quarterly newsletters, presentations like you're witnessing today, and of course, the weekly TGIF. Myself, I'm Meredith, Director of Client Experience, as I mentioned earlier. I work with a number of clients directly in an advisor capacity, getting to know your goals, your needs, and then designing and implementing a plan to meet those. Mike Harris, Director of Research and Trading, who will be presenting today along with Mike Frazier. And Mike's focused on investment strategies, designing and implementation of those strategies, and making sure they get executed with our trading team. Nancy Espinal, our Director of Systems and Operations. Her role is internally focused, but it's been really critical, especially these past 2 years, as we transitioned to work from home during the pandemic, and also as we work to return to the office in 2021 and continue to do so this year as well. Thomas Howard, financial planner and planning team leader. Thomas is focused on delivering retirement plans to many of you and education plans as well to help you meet those goals that you have set out. And if you are in need of freshening that up, please just reach out and he'll be happy to facilitate that for you. Nancy Treadwell, our senior financial planner, who celebrated 30 years with the firm in 2021. And we're so grateful that she continues to be a part of our team. And many of you are familiar with her great work over the years. Debbie Mitchell, advisor in financial planning, works directly with clients, again, developing the plan to meet your retirement goals or education planning goals. Through planning as well as the implementation of the investment strategy. Barbara Collins does financial planning for us from her home office in Loomis. Maria Agave, our senior operations manager, leading our operations team, opening new accounts, getting those funded, also any transactions that you have along the way, whether it's cash needs, wires for tax estimates, required minimum distributions, and the like. Yasmin Gomez works with Maria in operations, again, opening new accounts, making sure that all of the features on your accounts are up to date, beneficiaries, opening accounts, funding, and the like. Justin Ammett is our global portfolio analyst. So he's working behind the scenes on a global level to ensure that portfolios are appropriately invested based on your risk, based on your goals, and making sure that every client is properly reviewed and doing that on a global level for us in conjunction with Mike Harris and our trader, John Edelin. So John and Justin work really hand in glove, aggregating orders and getting them executed on your behalf. Aisha Isik, our office admin and portfolio admin. Many of you are familiar with her voice when you ring our office, and also if you need assistance logging into your client web portal. She is that patient person who will take her time and hold your hand through that. And we have a new face, Cameron Jameson, who joined us as an intern in the fall of 2021, and we're really grateful to get to guide him and for him to learn about our industry and be a part of our team. I also wanted to give you, well, again, it's been a year, more than a year since we've seen each other, a little bit of our year in review. We have reopened our office in a limited capacity. We did so in the summer of 2021. Unfortunately, with levels where they are right now, we're still open in a very limited capacity, but we look forward to this increasing in 2022 as local government guidelines allow. And we're really going to be embracing the hybrid model. So continuing to have some days where we're working from home, some days where we're working in the office, but making sure that we're rotating staff so that we can continue to meet your needs no matter the day of the week. Right now we're open in a limited capacity again today, a very limited capacity, but look forward to being able to see you more in 2022 when it's safe to do so. We've remained active in the community despite COVID. The organizations that we support have a greater need now than ever before. So we have continued to support those organizations. Some of these photos here are from an event we sponsored with Children's Health Guild, a community lemonade stand. Children's Health Guild, their beneficiary organizations are George Mark Children's House and Benioff Children's Hospital. Really, we've been believers in investing in our children for many years and continue to do so. By way also of our support of Moraga Education Foundation. Investing in children is so critical, and we've sponsored the Moraga Education Foundation again this year, and we emphasize education planning and financial literacy. We've been active with Save Mount Diablo, an organization that we have worked with and partnered with over a number of years. We were fortunate to be able to participate in their hybrid Moonlight on the Mountain event, which celebrated 20 years in the fall. And while we missed the opportunity to be live with students in our annual conservation collaboration, our staff participated in Earth Day service projects, and we were able to do a Zoom and share those and be active in the community, not just by sponsoring, but also with our actions. Especially during this pandemic, nature has been an outlet for so many people, and we are really grateful to be able to do our part to protect that. The traveling hat made a big return in 2021, and we were really grateful to be able to participate in your travels over the past year, from African safaris to Chicago to New York, Hawaii, and many places in between. The hat also visited the NBA championship game. It went to Gettysburg and also saw many, many family reunions and reunions of friends over the past 12 months. We're really glad to be a part of your return to travel in the past year. Thomas Howard, our financial planner, was named East Bay Financial Planning Association Member of the Year in 2021. We're really proud of his dedication and volunteerism in this organization over the years, which led to this recognition. Thomas joined our team in 2020, and he's increased the amount of communication to you guys in financial planning, blasts on Social Security, retirement funding, and the like, as well as a webinar on Roth conversions. So we're really grateful and proud of his recognition from the FPA. The media also came calling this past year, and Newsweek reached out to Mike, and what an honor it was for him to be asked to write 2 articles for the publication on innovation of logistics and travel. And Mike shared with me earlier this week that they reached out and asked him to write a 3rd article, which he's working on presently. So stay tuned for that. Congrats, Mike, on your publication. I'm really pleased and excited also to share with you that Bedell Frazier Investment Counseling will be featured on a segment of Viewpoint hosted by Dennis Quaid soon. Viewpoint found us when they were looking for an independent investment advisory firm focused on client communication and financial literacy. Bedell Frazier came up on their radar, in part due to our weekly TGIFs and Investing from A to Z, which Mike Frazier wrote and published a few years ago, and also those daily updates that Mike Frazier was sending you guys in 2020 at the height of the pandemic. I know many of you responded over that course of time saying how valuable those were to keeping you informed and being the voice of reason at a time that was very uncertain. Education and communication have always been cornerstones of our firm, and we're very excited to have been chosen by Viewpoint to be featured in an upcoming segment, which will air on public television. As soon as we have that air date and details, we will share it with you so that you can tune in and share in our excitement of that viewing. So that's just a short recap of what we've been up to behind the scenes here a little bit. I know you are all tuned in here, though, anxious to know what's coming in the future. So without further ado, I am going to hand things over to Mike Frazier and Mike Harris to share with you our 2022 market outlook.
Thank you, Meredith. Happy New Year, everyone. I'm Mike Frazier, and this is Mike Harris. Welcome to the friendly confines of our office. We certainly wish we were doing this in person, but whatever it takes. And what a year it's already become, just 3 weeks into it. I was talking to a friend of mine who has a firm back east, and he said that 2022 seems like it's going to be a pretty complicated year. And I laughed, like, dude, it's been a complicated decade, and we're only in the 3rd year of it. So obviously, volatility has gripped the market as we started off, and it's really driven by higher yields, what the Fed is going to do, and inflation. And we're certainly going to cover all of those subjects. I think the most recent bout of volatility, particularly yesterday, is the market seems to be sniffing out that the Fed might be doing more, and there's some whispers that they might start with a 0.5 point cut in March. So we don't think that happens. We don't think that would be the right move, but the market's going to do what it's going to do. And I think about it, Bill Schaub always mentions that, every time we have our event, it's always around some sort of turbulent market environment. So, it must be the Bedell Frazier market outlook. So corrective price action has certainly been a theme. The other thing that sort of struck me was, we ended the year, with the stock market at all-time highs, but sentiment is really, really sour. The University of Michigan consumer sentiment gauge was the lowest to end a year since 2008. And that was the year of the financial crisis, if you recall. And investor sentiment is back down to the COVID crash lows of March of 2020. So there's not much euphoria whatsoever. So as a contrarian indicator, that's positive. But there's a lot of things that are plaguing this market for sure. And we certainly plan to cover them. But there are some similarities to the dot-com bubble period in the 1990s. We'll put things in context, but there's a lot of dissimilarities too. This is a unique bull in its own right. So what we're going to do is frame what we see, provide context in things, and then really map out our action plan for 2022. And I think that something happened yesterday that was promising as a long-term investor, is Microsoft made a pretty bold move saying that valuations have become pretty attractive, and they're acquiring Activision as a bold move in the metaverse. So long-term investing and growth absolutely is still a major theme, but you sort of have to get past the now, and we're really focused on the now. And I outlined in our newsletter, the Outlook, which was like 2 weeks ago. It seems like it was ancient history. We've already moved on some of those action plans, and we'll talk about those as well. So what do we do? Well, when you look at the market, there's a lot of things that are impacting the price volatility, but when it comes down to it, the primary driver of stock prices are earnings. Okay. Now, just as a backdrop, we're sizing up this bull. Okay, this bull market, it'll be 13 years old in March, assuming it gets there. There's been a bit of a sell-off, but nowhere near getting to a bear market level for the S&P. The Nasdaq's a different animal. But this bull market started in the ashes of the financial crisis in March of 2009. And it was the longest uninterrupted bull ever, 11 years time. And that ended with the COVID crash. But the secular bull market is still alive, and secular meaning long term, okay, which started in 2009. And what did the COVID crash do? Well, it ended the cycle. It cleared the decks for this new bull cycle. And we saw the fastest bull to bear ever. 24 trading days. Think about that. When the S&P fell 35%, the Dow was down 30+% as well. But it was also the shortest bear market we've seen. It was only 19 days. And then it became a crash up, if you recall, fastest bear to bull, 12 days. That's all it took. So, it was pretty violent. As Meredith pointed out, I was writing daily, and I will never forget those days. It really was gut check time. So for you historians out there, you'll recall the previous secular bull market was 1982 to 2082 was when inflation peaked. That's the last time we were really facing inflation, right? Reagan was in his second year of his first term. Now, there also was a bear cycle during that time, 1987 crash, okay? So, but there was a secular bull market that continued through the 90s into 2000. And then, what we learned the hard way was the 2000 to 2009 period was a secular bear market with some cyclical bulls in between, okay? Right, going back to it, what matters most right now? Earnings. That's what drives stock prices. And Mike's going to talk to you about that.
Great. So let's jump right into earnings. Like Mike said, what we lived through ending 2019, into COVID 2020, and out of it into 2021, really nothing short of remarkable. It's historic for many reasons. You can see here we plotted earnings. 2019, we earned $152 a share on the S&P 500. Was pretty flat year over year to 2018. We know what happened in COVID with the economy shutting down. Earnings dropped a remarkable 17%. To give perspective to that, it wasn't even that sharp of a drop in the financial crisis in 2008, 2008 and 9. Then 2021 was the highest increase or rate of change terms, 53% increase in earnings off the depressed, obviously low that we saw in 2020. Q4 hasn't been officially reported yet, but Q3's, the first 3 quarters are obviously in the books, and with estimates pretty tight coming in into earnings season, which starts here shortly. We're looking at $194, which again is that really the highest rate of change, 53% growth in earnings.
That's got to be a record.
It is. I tried to go back to the 20s and 30s. The S&P wasn't created till later, so you can throw a number together, but you can't really.
Maybe post World War II or something, but that's it's.
We're just going to say it's the highest probably rate of change terms with the highest certainty of all time. So we're looking forward this year, 2022. Wall Street estimates that we get through Bloomberg here are forecasting $226 in earnings, which would be still really impressive growth. We can see back in 2017 was 13, which was a really good stock market year. So up 16% off of the backs of a 53% is pretty good growth. As Mike said, and we always know from the fundamental perspective, earnings drive stock prices. But you need perspective inside those earnings. And the biggest perspective that we can look at is valuations. If you have a market that's super expensive and not really growing, it's much harder for stock prices to advance. Where in tandem last year, we really weren't worried about higher valuations entering 2021. We put in the newsletter, we put in the technical piece that we really saw. I mean, it was systems go on the economic front. Margins were expanding because inflation hadn't hit yet. Corporate America was lean coming out of COVID. So everything was set up to really fire higher in earnings last year, and we saw that. So we really weren't really worried about valuations, even though they were, historically high to previous.
Well, the growth rate was so high, and it also eclipsed the pre-COVID level, right?
So it outstripped it. So again, valuations didn't matter. The reason we bring this slide up this year is because we think valuations are going to matter more to the stock market in 2022 than they did in 2021. So just wanted to have a call out here. Back here from the 1997 to 2000 period, which is really in this box, the S&P 500 traded between 20 times earnings and 26 times earnings, which you can see obviously to present day coming into, here's 2017. So this was coming out of COVID, right here, 20 to 26 times. So we're in that general vicinity of historically expensive multiples that people are paying for the S&P 500. We're gonna get into some more granular stuff behind this, but you can see here, we plotted the green 25-year average, which is closer to 17 times earnings. So we definitely are more in the expensive side, and we do think that it is going to matter much more this year than we get into. And so with that, we're going to go into the economy, which backs earnings and valuations.
So the economy obviously matters, and you could see the fourth quarter of 2020 on the slide here. The U.S. economy was growing 4.5%, and that was in recovery mode. But it really accelerated last year, 6%, 6.4%. I mean, those were growth rates that had not been seen for decades.
Long time.
Yeah, obviously it came from a very washed out level. But what's interesting is you might notice in Q3 it was 2.3%. Okay, a deep deceleration. Well, what happened there? Well, Delta, and then Omicron later on. Okay, but that was that Delta slowdown that happened in August, where it sort of derailed a lot of summer vacations, back to school. It was a big concern. But also there was a lot of front running of holiday shopping because of the supply chains. Okay. Yeah, paying forward. So that's why it's a little bit skewed, but it looks like it's going to be normalized. I think, for Q4, it's supposed to be like 5.8% or something like that. So all in, it's going to be a blended 5.4% growth rate for 2021, which is a really strong number. Keep in mind, it was roughly flatlined at 2% growth, all of last decade. But it's gonna, settle back in. Right now, to our 2022 estimates, it's a pretty wide margin, anywhere from close to 2.5% to 4%. Why is that? Well, first of all, Omicron is playing a big role because, there's been shutdowns. People aren't spending as much. Psychology certainly plays a role when you're spending. But the other thing is, fiscal stimulus, that Build Back Better plan, which originally was supposed to be $6 trillion, then we were talking about $1 trillion. It's going to be less than that, if anything. And you look at that, a $1.3 trillion drop in spending from Congress is equivalent of roughly 5% of GDP. Yeah.
Fiscal draft.
Yeah. And keep in mind, though, the infrastructure bill was passed, 1.2 trillion. These are big numbers. I mean, 1.2 trillion. It's just incredible, the numbers that are being thrown around these days. But anyway, and the bulk of that decline will be felt in Q2, and the market is sort of sniffing that out too. So, comparisons really matter. The next slide talks about jobs. We've talked about the Great Resignation. This is through August, but you can see the number of quits was 4.1 million in October. It actually was 4.5 million in November. Look down to the bottom one, the JOLTS layoffs. You can see the spiking, during the COVID crash because the uncertainty was going on. Companies just need to let people go. And then look at the number of job openings on the left. And that's a big deal right now for the reopening of America because there's over 11 million jobs, that need to be filled, and people are quitting. What are they doing? Well, there's some people that I think are having a reassessing life and wondering, is this really the career that they want? Some people don't want to work in restaurants. Healthcare saw a huge decline. People don't feel safe. COVID is certainly playing a role there, but there's also a new breed of entrepreneurs, that are popping up, that are selling things on Amazon and Etsy. There's a new generation on TikTok and YouTube and the like. And I'm not sure the government, is accounting for them. The participation rate, the labor participation rate is 60%, multi-decade lows. That means that 3 out of every 5 people in, that labor pool who are, that seeking work. Correct. Yeah. People that are of working age are actually seeking work. So that means 2 out of 5 are not. My neighborhood and throughout the Bay Area, you see a lot of people in the pet industry, whether you're dog walkers or groomers or whatnot. So, I think that the entrepreneurs have really taken flight. So that's something going on, but it's a big issue because we can't fill these jobs, and it's mostly in restaurants and hospitality. And with the reopening of America, which we think is really going to, take hold this spring and the summer, it's going to put a lot of pressure, and wages have obviously gone higher for the first time in a number of decades. So that's where, the inflation issue is still going to be problematic, and the Fed is going to have their hands full in, sort of toggling that, but they're also going to run the risk of creating a lot of stress, in the financial system. Fortunately, the credit markets are not showing any signs of stress, but they will if they go too far. And we're going to talk about that in a sec. But Mike's got this quadrant chart that I love.
So we showed this back in the November presentation, and thank you for your feedback. We got a lot of clients that like this, so we thought we'd show it to you again, because really it's a map of sorts. It really tells a really good story of, it's almost like a North Star of where the market could go based on where the economy is. So I put a big start here in black, and this is in 2020 to kind of give you a roadmap of why we saw the volatility in the equity markets. Obviously, it was based on what was happening in the economy. And I'm going to pull it forward to 2021 and where we expect it to look like in 2022. Again, tells a really good story. It's like a map. So we started in January 2020. Right here is the growth quadrant. When the economy on manufacturing and services is growing, the dots are going to be out here. Okay. When manufacturing and services or the economy is actually decelerating or not growing / contracting, the blue dots are going to be on this side over here. And then inflation is on this axis. So when inflation is accelerating, the dots are going to be above, okay, the middle line. And when inflation is decelerating, they're going to be down here. And I hope that really kind of shows you where we're here from some perspective. So we started January. We had some growth and we had inflation. Both were accelerating. All of a sudden, we got the COVID news very early that year. Stuff started to get a little not knowing what's going to happen. February data came out and the economy definitely slowed. You can see the blue dot went to the left, inflation went down. And then we know what happened in March. COVID officially was here, shutdown started happening. So the economy here moved to the left and inflation decelerated. And then with the market, the economy officially closed, the economy accelerated even further, way down here, and inflation was down here. And this was the worst of it. If you recall, that's when the fiscal intervention came in. That's when the Fed started going really, really big. And you can see we bottomed here economically, started to work back, growth started returning. I don't know why it's doing that, I apologize. Growth started returning, and then into June was the huge acceleration. May to June was when growth started to actually show acceleration. Again, inflation started coming back a little bit, and then July, and then August, and then we had a little setback into September of 2020, and then accelerated into the end of the year. So that's a really good roadmap of why the markets did what they did. Volatile at the beginning of the year because the economy literally was in recession, shut down that way, and then it crashed. And then we had this inflationary boom way up here to end 2020. So we're going to go into 2021. We started 2021 in this inflationary boom camp. So the reason the markets were really so strong last year is because we never left the inflationary boom camp. We were up for the entire time. And when inflationary boom camp is when growth is accelerating and inflation is accelerating. That's historically pretty good for equity markets, and we saw that last year. So January started, we had a little slowdown in growth, increase in inflation, and then a huge move up in growth into March, and then really through the back half of the year. So I'm setting all this up to this November to December move, okay? This was really the first time coming out of this growth phase, accelerating, where we saw growth actually go back the other way. Inflation is staying elevated here, okay? It's no longer accelerating, but it's elevated on the last print. But growth is starting to come back down this way. And the reason we call that out is because when we started the onset with talking about earnings and valuation, and now where the economy is, the reason we think valuations are going to matter this year is because we're entering this phase where we do expect growth to start, reverting to the mean. We had such an enormous move up out of COVID that a reversion to the mean makes a lot of sense. That the flash manufacturing numbers that we got this week, which were from December, obviously Omicron hit towards the end of the year. So those are factored into the numbers. We saw them start to slow a little bit. So in our estimation here, the slowdown in growth in December is likely to continue a slowdown in January. And like Mike talked about on the prelude here, the market's starting to sniff out that with what's going on in the Fed. So we think growth is going to come back the other way just a little bit into early 2022 here as we start the year, before setting up growth later, which we're going to get into. So we talked on earnings, we talked on valuation, where the economy is, a little decelerating growth, but nothing like we're seeing growth all the way back into the 2020 region. And then we're going to get into talking about inflation, and we can't do that without talking about energy and commodities.
Right, inflation, that phantom tax. We certainly notice it at the pump here in California for those who still drive gas cars. But close to $5 a gallon. It's really important. I mean, the price of oil hit $85, I think, this morning. Multi-year highs. Demand for gasoline and just energy in general, as the economy continues to recover, is really, really strong. And when it comes to oil and natural gas, production has actually shrunk quite a bit. And this chart here tells a really good story. That the top one on the left is production, okay? And you go from year 2018 to the estimates of this current year. But roughly 100 million barrels a day are produced every day. That dropped in 2020, during the COVID crash, and then it's gradually been making a recovery, but 100 million barrels. Then if you look at consumption, we had some pretty tight supply. We actually were consuming less than produced in 2018, and that flipped in 2020, 2019. And you're seeing that there's not that much capital expenditure, especially in the US. We've been producing less than we were in 2015 and 16, although that is starting to pick up again. Part of that is just the greening, of America, ESG, renewable energies. The fossil fuels are, quite controversial and obviously not good for the environment. But you notice in the bottom left, active rig counts, it's picking up again. So, production is chasing price. Okay. Now, energy was the best performing sector last year, up almost 50%. And right now, I think after today, it's probably the only sector that is in the green in 2022. And we can make a case, the price of oil could see $100 a barrel because there's just not as much supply and demand is really strong. OPEC is certainly not producing as much as they think they can or want to, but they also are enjoying higher prices. But, last time we met in November, we talked about inflation and there were some signs of things peaking. Well, oil continues to go higher. Natural gas prices peaked last fall and have fallen like 30%. And the price of corn and wheat, they've declined too. So the stuff that we, use, that we consume on a daily basis, we've seen actually some price decreases. And in the case of CPI, which was up 7% in December, okay, year over year, highest in 4 decades, the rate of change is slowing. And it sort of, seems to us that we might have peaked at that 7%. And we're still going to see elevated prices, but the rate of change is going to slow quite a bit. And that's what the Fed really needs to pay attention to. the market is certainly paying attention to that too. So, natural gas prices are 30% off the highs. What does that mean? Well, a lot of our manufacturing is driven by natural gas. Fertilizer too is a huge ingredient in fertilizer, which is driving agriculture. So, lower natural gas prices is beneficial for all of consumers and multiple industries. So that's really important. The other area besides oil that we think that inflation is going to be a problem when we talk about wage inflation, but also rents, right? That's also something that chases the housing market.
That's what we touched on in the fall, was that rents lag in the CPI index. And the reason in November and December we're getting stickier 6.8, 7.1 readings on CPI was because rents finally caught up to housing prices, which were up 18, 19, 20% year over year. So you're going to still see rents come up a little bit and used cars come up a little bit because they lag. And the rest of the CPI, as Mike's talking about, the larger basket is starting to flatline, which means that acceleration year over year isn't going to be like we saw in 2021. So if we didn't peak in December, we were going to be real close here in December. Doesn't mean we think inflation could go from 7% to 0 again. But we think that we're at peak inflation for this part of the cycle.
Yeah, and all the while the Fed, has its work cut out for them because the unemployment rate is down in the threes. Right, there's a lot of jobs that we can't fill. We can't find the workers, and price stability while inflation is still elevated. So they're going to have to try to navigate this thing, and the market is certainly going to force its hand. Yeah. It's already doing that, and it's sort of creating.
And that's what we're seeing in the market over the last really start 2022 here. Right now, the market, when we say market, we're talking about the 2-year Treasury yield, which is yielding over 1% yesterday when I updated the slide. And the federal funds rate, so where the Fed is holding the benchmark interest rates, are still in emergency policies. You can see it as a green line. When COVID hit, they dropped them to 0, and they've left them at 0 all the way through today. So they're literally in emergency policies. And the 2-year yields started percolating a little bit in 2021, and then really the end of the year, Q4, and then to start this year saying, hold on, Fed, you got to start raising interest rates. The market always leads the Fed. You can see here, back in the day, the 2-year yield was coming down before the Fed lowered rates. So it always happens this way. It's going to happen this way again. So what does this mean? Well, the 2-year yield right now, the market's pricing in 4 rate hikes for 2022. If it goes a little bit higher, it could be pricing in closer to 5, right? Sniffing out 5. So the market's saying the Fed needs to hike 4 times this year on the front end here. So the front end, the 2-year Treasury, because it's close to today. Now, the part of what we're really trying to go through right now is making sure the Fed doesn't create a policy mistake with raising rates too far, too fast, given the Omicron news, given this kind of slowing of growth that we've seen entering 2022 here. So this is a slide of the pink line on here is going to be your yield curve, as we call it, the spreads. And what it does is it takes your 10-year Treasury, which is further out in time, and it takes that yield and it subtracts the 2-year Treasury yield here. So when the economy is healthy and accelerating, you want that to be steep. You want 10-year yields to be way higher than where 2-year yields are. Right. And then
you have to be compensated for that risk.
Correct. For lending for next 8 years.
That's the way the banks make money too.
Exactly. So you've heard the term inversion. We've talked about that 4 years ago when the curve first inverted way before COVID. That's when 2-year yields and 10-year treasuries are at the same, and then actually the front end of the curve goes higher than 10. When the curve inverts, it's not good for the economy. It's usually forecasting some sort of economic slowdown, whether or not it's a recession or not, isn't always accurate. But nonetheless, where we are today, we're at 0.81%. 10-year treasuries are 1.85. I just showed you the 2-year notes at low ones, so that spread is 81 basis points today. We got up as high as 1.5%, which was a really nice, steepening of the yield curve, and that was in the spring of last year, so almost a year ago now. That was kind of peak excitement of reopening, right?
That's when they should have started.
They should have started, exactly. I think we said something like that, one of the TGIF's newsletter, really needed to start to raise rates then. Didn't happen, obviously. We left them at 0 for another year. So here comes the dilemma that the Fed has, is that the curve is what we call flattening, from 1.5 down to 81 basis points. And if the Fed starts to increase the front end of the curve and the 10-year yields stay flat, it flattens even more. So they can force this lower. They can force it towards zero. They can force it towards an inversion. We wanted to show you the last time the Fed made a policy mistake. If you guys recall, Q4, it was really that was November, December of 2018, really.
It led to the Christmas massacre.
Yeah, so for Powell here, we were already in a rate rising hiking cycle back then. So it wasn't the first hike out of zero, but the yield curve had already come all the way down to about 25 basis points here. And Fed Chairman Powell raised rates a quarter point, and that threw the markets into a tizzy because it was already saying growth is really slowing. You don't need to raise rates anymore. Don't worry about inflation. Full employment's okay. So he rose rates there, and you know, in our estimation, warrants his lesson. But he's further behind the curve here because we have almost a 1% spread here, which is really large in Fed speak. So I outlined here the last time we embarked on our rate rising cycle. If you guys recall, interest rates are at zero from the credit crisis, 08-09, we took them to zero. Left them there all the way to 2015. So there's basically 6 years, 7 years of 0% interest rates. And the yield curve was at 1.3% when we started raising rates out of the financial crisis. So much steeper. And then coming out of the dot-com, okay, when we had the bear market in 2002 and 3, when they started raising interest rates in 2004, this was the spring of 04, the yield curve was closer to 2%. And obviously when they raised rates, we started to see the yield curve flatten. So we're really cognizant of the Fed's threading the needle here. If the market says you need to hike 4 times, and then the yield curve is saying, well, we're not so sold on hiking 4 times yet. Right. We need to see some more data and see it.
And I love the quote James Carville, the bond market can intimidate anyone.
Sure, yeah,
absolutely.
Sure, yeah, it's doing a good job of it right now. It's doing a good job of it right now. It really is. So that's kind of a precursor to this next slide. I bring your attention to market volatility. And what I plotted here was just bring your attention here to what we deem risk or the standard deviation of returns on the S&P 500. And I put a red box. Anytime the standard deviation of return on the market is outside here, that means that the variability in prices is wider to the mean. So I guess a kind of a funny joke is, you know, you can measure like my children. I can look at my 2 boys and say, one of them, I know when he's upset or I know if he's hungry. Within a variability, you know, what his behavior is going to be like. He's less erratic. He's tighter. He might throw a little bit of a temper tantrum, but not really. He's got a low risk, low volatility. And then my other child, sometimes when he's in the same way, he's predisposed to maybe having a more erratic behavior.
He gets angry.
He gets it. So he's got more volatility in his behavior. Okay, the market's very similar to that. Yeah. And I plotted the average here. You can see the average standard deviation on the S&P is close to 18%. This is going back 25 years, actually 22 years on this. And last year we were way inside it. We were super low. We were at 13 and change percent last year. And I just wanted to call out why 2020 felt like such a wild ride. If you went to Disneyland, you know why it felt like the Matterhorn. Way out here on the volatility metric, so way above average. And you can see that when you get higher volatility, the stock market is usually showing negative returns. So you can see when you have above average volatility here, you saw negative returns, and then 2008. So 2020 was abnormal because the returns were negative, and then we closed the year positive, and the volatility was up. So I'm saying all this because our expectation is after having a year where volatility was 25% lower than average, that we're going to see an increase in volatility this year. Highly likely in 2022. It's already started. When we were preparing for this presentation before the year started. So I'm showing you that.
Yeah. So there's been a lot of comparisons to today and the dot-com days, and understandably so. You've certainly seen the dominance of tech, the tech titans, the FANG names. They have really dominated the stock market and the digital economy for the better part of, over a decade. We also saw with ultra loose monetary policy, I mean, it was a magic elixir for what's called risk assets. And a lot of these speculative, investments, these story stocks, SPACs, cryptocurrencies, I mean, you name it. So we just want to frame things, for comparison, because if you look back, after the bubble burst in 2000, and it was a 3-year bear market, but Amazon fell 87%. And obviously it's a survivor and it is a dominant player in the digital age. Intel was down 83%, Microsoft down 58%. If you look today, I mean, a lot of damage has been done. There have been bubbles that have burst under the surface already. Zoom video, we're on Zoom right now, right? It became a verb in 2020. It's already down 73% from its highs. Teladoc, 75%. That's a stock that we owned and we sold it like 30%. And I mean, you got cut in half since we sold it too. DocuSign, I mean, that's a long-term investment. We think that, it has a pretty strong moat and an opportunity ahead. We don't think that we're going to return to a paper world. We think that, electronic records and documentations, that is absolutely, the future as well as the present. That stock's down 58%. So part of it has to do with just, being priced for perfection. I would add, Bitcoin's down 40%. Peloton, a stay-at-home story stock. I don't know if that's a survivor or not, because I don't know if it has any unique properties, but that stock's down over 80%. So a lot of the, the damage has been done already. So, we don't think that we're going to see a major market sell-off. It's just really focusing on, the really most expensive area that Mike talked about, that just had bubble-like characteristics. Something interesting at the bottom, Intel still has not hit that high from 2000. Right?
And it's all because of valuations.
That's right.
That's why we showed you slide 2.
Multiple compression, right? I mean, they continue to grow revenues and earnings, but they could never grow into that multiple. The next slide. So, after the bubble burst, the S&P was basically cut in half. It's down 47%. The NASDAQ down 76% from peak to trough. And the Dow was down 35%. But I show you on the right too, not everything did, right? Coke was down 10%, it had a nice predictable dividend back then. Walmart was down 4.5%. Johnson & Johnson was up. The point is there's areas to hide. There's areas to make money and play defense, during short-term periods. And, we have to remind ourselves.
And to be real clear, we don't think we're in this environment right now. We're just showing the comparisons of that.
But
this is a couple years down.
But later in the decade, there probably will be a time, and we will always have a playbook for that. And the other thing I thought was really important, I was just, doing a bunch of analysis, and small cap value, that factor was the best performing, sector. It actually went up 20% in 2000. It was up another 14% in 2001 when the NASDAQ was bleeding. So, and that's our job, is to figure out the areas that look really well. And we sort of outlined in our, Outlook newsletter, and we've already pulled the trigger on some of those things. And Mike's going to talk about, well, wait a second, one more. The concentration, okay, this is also a really big issue. You have a third of the S&P 500 is concentrated in 10 stocks. And when you combine Apple and Microsoft, those two stocks alone are 13% combined of the S&P 500. Okay, and they're not cheap, but they have high quality characteristics. But their stocks, gravity will play a role for them as well. But Apple reached the $3 trillion threshold. I remember it's a big deal when we hit $1 trillion and then $2 trillion. It's like the law of large numbers. But the stock continues to have strong demand and quality characteristics. But if Apple was a standalone nation, it would be number 5 in the world. It'd be ahead of the UK and just behind Germany at 3.8 trillion GDP. And how about this? Apple is worth more than Walmart, Disney, Netflix, Nike, Exxon, Coca-Cola, McDonald's, AT&T, Goldman Sachs, Boeing, IBM, and Ford combined. Imagine that.
It's nice.
Yeah. So, markets do go down. We also have to remind ourselves, and it's healthy. It's not fun, but it's healthy. And corrective price action is just part of the market ways. And during those times, We just need to hunker down, play defense, and these are some of the things that we're seeing.
Yep. So I know this is a busy slide, but I think it's going to drive home a really, really cool point of where the market's been trading, where leadership has been, and where we're seeing signs of percolation of where leadership's going to actually revert and take over the areas that have been underperforming. The first slide I want to bring your attention to is we're still getting bull market action. When we define bull market, it's when cyclicals. So you talk about industrials, technology, financials, and so forth outperform defensives, and we define defensives as right here: staples, utilities, healthcare. Not on here, but it's telecom. When cyclicals outperform defensives, bull market actions, talking about breadth, stuff that's economically sensitive is doing well, outpacing its defensive peers. This line goes up. Coming into COVID, we actually saw the opposite. So we're still in this, bull market cyclicals versus defensive. One of the biggest drivers of this behind here has been technology. And this is a 2.5, 3-year chart. And this just plots technology.
That could be a 10-year chart though, too.
It could, yeah. It's had, bouts of underperformance, but really by and large, it's gone, from the bottom left to the upper right for a long time coming. All these green charts, okay, they take that sector and it's just that plotted against or divided by the market. So when the green line is going up, it means that sector is outperforming the broader index. When the green line is going down, okay, like healthcare was for a while here, that means that sector is underperforming the broader market. It doesn't mean that those stocks are going down. It just means they're not going up faster than the markets. This is how you figure out relative, what we call relative strength, areas of leadership. So tech has been that leadership. The defensives, as you can see, staples up here, the green line went down for the last 2 years, starting to look interesting, starting to percolate here. Utilities, rate sensitive, okay, starting to do the same thing, trying to come off this level. Healthcare's been here. We had a shot here, and now it's trying to turn back up again. Technology, we got a little turn here. I wouldn't say that we're calling a top in technology by any means, but for it to just kind of be an underperformer for a quarter or two would make a lot of sense, given where we are there, and we're going to do a little bit of our action plan. And then energy had a good 2021, and then really it's reaccelerated into the beginning of the year. So we're seeing a turn maybe of this cyclical.
And keep in mind, energy was left for dead. I mean, it was a huge underperformer last decade.
Yeah. So best performing sector last year, and it's been the best performing to start 2022. So we've definitely made some transactions here in the portfolio to get exposure to these more defensive spots as their relative performance is starting to percolate. The dividend yields in these areas are much higher than the broader market, and they're much higher than when you're talking about just growth. A lot of consumer discretionary names in tech don't pay dividends. So hunkering down here and hanging out for a couple of quarters while they pay a higher dividend yield. And then, like we showed on the previous slide, on valuations, they are much cheaper than the broader market. So when you look at utilities, healthcare, staples, and energy against the broader market, they are cheaper on a valuation basis, which means that you have support there. They're not basically susceptible to as big of a falls as some other areas that are in the high growth areas. So that's our rationale of showing you this slide and what we're doing about it.
And dividend stocks do much better in a rising rate environment.
Yeah, which we've seen the first couple of weeks of this year. Another area that we're interested in, we talked about it last year, and we never really pulled the trigger. The domestic growth here in the United States was much too strong last year. Like we said, we weren't really worried about valuations, and earnings growth was exploding. So we pretty much stayed domestically focused with our equity investments. This year, we're changing that. We took a position in an international index fund that is the all world constrained, and it does not have any United States exposure the way we look at it. And the reason, a lot like we just talked about staples and utilities and healthcare, is that the price earnings multiple is much cheaper, 14 to 15 times, where our markets, like we showed you earlier, 21 to 22. The dividend yield abroad, much higher, over 3%, where our S&P yield is right around 1.25, depending on 12-month year over year. So much higher. So you're going to get paid for hanging out there. As Mike and I were talking about, it hasn't gone up nearly as much as our markets. Last year, this international index fund was up, I think, 7.5% against our Dow, up double-digit teens and S&P in the 20s. really underperformed. We think that's going to change. So
It underperformed all last decade too,
yeah,
but it outperformed the decade before.
correct. So we like it because it's got valuation support here. We want to get a little bit more defensive, a little move up the quality chain in the portfolios, and this is another reason for that. They also don't have the fiscal drag that we have. Mike talked about the 5% of GDP drag with our fiscal money spending less this year than we did last year. They're not susceptible to that.
Go back to that for a sec. Also, the makeup is quite different. Technology is a much
Great point.
lower,
Yeah.
Allocation
It's
size.
less than 10%.
Yeah, whereas consumer is like 20%, right? Banks are on the
Financials are
higher side.
18%. Where
Yeah.
technology here domestically is 24, 25% of the S&P.
Right.
There it's like 9 or 10.
Right. So it's not, so the European economy in aggregate isn't growing as fast. The stock market isn't growing as fast, but it's more predictable, right? And cash flow.
That's a
Focus.
Yeah, so we think it can outperform, if not the whole year, definitely the first half of 2022.
Yeah.
We're looking at it. Okay, we got to talk about the bond market. We talked about the Fed, we talked about inflation. Where's the bond market? Well, 2021, as we told you, was our goal, was our motto here internally. Do no harm on the bond market. We were expecting a rising rate environment in 2021, and that's exactly what played out. Interest rates went from sub 1% to over 1.5% on the 10-year Treasury yield. So the global bond aggregate index was down over 4%, and the U.S. aggregate was down over 1.5%. So we told you we're going to do no harm. So what did we do about that? Well, we kept our maturities really short. Our duration against the benchmark, as you call it, was shorter, which means we were less interest rate susceptible. Interest rates go up, bond prices go down. If you have a shorter duration, a shorter maturity date, you're less susceptible to those rising rates having a negative or adverse reaction in your bond prices.
Yeah.
We avoided treasuries, which were the worst performing part of the aggregate index last year, and we were overweight cash.
Yeah. We also had preferreds too, which did well, and there's a big spread between what preferreds pay and treasuries.
Absolutely. So we're able to eke out a positive return there, setting coming into 2022. Well, our stance is changing from do no harm to we think 2022 is going to be a year of incrementally getting back to a more market posture, market positioning. What we mean by that is we were shorter on interest rate on maturities, we were heavy cash, we were void treasuries. We're going to start to build that back out. So looking more at the sweet spot of the yield curve, which is that 7 to 12 year part of where we're getting compensated in the portfolios the most, as well as now that rates are up through 1.5% today, getting interested in treasuries, starting nibbling back on those, which again we were avoid last year, which helped us not lose money in the bond market last year. So getting back to a more market posture with our bond allocations this year is our strategy for 2022. Rates have already jumped 1.5 to 1.85 today. That's Mike was talking about the velocity of what's spooking the market a little bit right now, waiting on what the Fed's going to do. So already both aggregate bond market indexes are down on the year, which is interesting because that old 60-40 balanced portfolio, you count on bonds for lower risk, right? To hold in, to do better when equity markets, and that's not what's happening right now, which is why we are very happy that we still have our 2021 positioning right now going into 2022, because now with our dry powder, with our under position, that we can start to get a little bit more aggressive, get to that market posture at lower prices. As rates go up, we'll purchase those at lower prices. So that's our outlook for the bond market.
Plus, for all our clients who've been with us for a long time, we locked in, bond yields 10 years ago and much higher rates that are finally going to come due this year, next year, in 2024. And at that point in time, we roll that money back into seemingly higher rates than we are right now.
Which is much better to do it this year, okay, with way over 2% on corporate bonds versus last year was low ones, right? I mean, it's incredibly different.
Right.
So looking forward to putting that action plan as market conditions.
But putting fresh money to work in the bond market this year looks more attractive than it did in 2021.
No harm, back to market posture.
Yeah. So, something that's always an ever-present danger, the market seems to be ignoring for, really the last couple of decades, seems to be coming back to the forefront. And it's no surprise that, the U.S. strength and resolve is being tested. The political divide, the president 1 year in, having trouble getting things done, collaborating with the midterms ahead, Russia and Ukraine, saber rattling. There's a real threat, it sounds like, that there could be some, sort of war. What they're trying to do is build out the sphere of influence, and, Putin wants to kind of rebuild the Soviet empire. China is watching very closely. They know that when Russia annexed Crimea, that we really didn't do much. Europe didn't either. NATO is very aware of that. So they're, paying very close attention as they deal with Hong Kong and Taiwan to see what the rest of the world will do. Iran and North Korea, just launched the missiles the other day. And Iran wants to go back to the table, but, they're going to have, restrictions. We'll see. There's a lot of vulnerability right now, and there's a lot of distractions because, the U.S. has a lot of issues to deal with domestically. And it's just hard to get things done. And that's why we think that, we're not going to see much in the way of policy change in 2022. Importantly, Kazakhstan, it's an Asian nation that borders Russia, and the Middle East. They are resource rich. They're one of the largest oil producers, but they are a huge uranium producer and also rare earths. And those are really important for consumer electronics, batteries and, devices in the digital age. So that's, something that everyone knows, whether it's Russia as well as China and the US, how important that is. And that's why we might see that be a bigger issue later this year. Globalization has historically been about economics, right? Free markets. But there's been a big shift towards protectionism. And that's becoming a bit of a risk too. The rules have been changing sort of, right? And that's what makes it harder as an investor. Yeah.
Really change that as well.
Yeah. And, we're certainly seeing a lack of trust, dependencies on each other, right? Supply chains. During COVID, we weren't feeling all that comfortable with, China being a partner, in some cases being held hostage, from what it is that they were doing. We know what happened with supply chains. It looks like things are freeing up, although China locked down again, and you start to see some more disruptions. So it's a big deal, and it just seems like the geopolitics finally is going to catch the market's attention. And the other thing I talked about, the midterm elections. So we got another election in November, and the odds of the Republicans retaking the House are very high. That's why we don't think that, they're already in election mode and not going to get anything down. It seems like, the Democrats are trying to build up this Build Back Better plan and have it even more scaled back, but it just doesn't look like
piece a couple together now.
Yeah. But our sources in Washington think that, they're not going to get anything done. So from an investor standpoint, capital gains and the estate taxes aren't going to change. So the market likes that.
About that.
Yeah.
I have to go.
Yeah, for sure. That was a big issue, although it seemed like it was, going off the table like mid-year last year anyway. But the Republicans just need 5 seats to flip the House. And since World War II, the party of the first term president, so Republican or Democrat, has averaged a 26-seat loss in their first term elections. So, that doesn't bode well for the Democrats. It looks like the Republicans will take the House. That, the Senate seems like it's a total toss-up. I think that there are more Republicans that are up for election than Democrats. So the math is a little, different. But the one thing that's really important for us to all understand is our adversaries really love the fact that America is in turmoil and we have this political, social, and economic divide. But us versus them is we Americans, and they sense vulnerabilities and they are paying very close attention. And obviously, some of our adversaries are trying to participate in our elections. So that's a big problem. So. But that's, earnings are still what drive prices. The Fed is certainly going to be a big influence on the course of the market this year. And here's our path, just summarizing what we just sort of covered and what we plan on doing.
As we showed at the very beginning, we expect earnings to accelerate. We think the economy is still going to be an expansion, but that rate of growth is going to be slowing. So it puts us in a unique position because valuations are up against the historically high end of the spectrum. So we think that 2022 is really likely to be a tale of two markets, both bullish and bearish. Wall Street strategists, as well as bulls and bears, are highly likely to be right here. We showed you why we think increased volatility is going to play a role. With increased volatility means that we're highly susceptible, and we would say probable that we're going to get a 10% correction. 2021 we didn't have a 10% correction. The worst drawdown we saw was 5%, which is historically low. We usually get a 14 to 15% pullback intra-year on average, going back 30 plus years. So 5% correction last year was very mild. So it's very probable that we'll see a 10% correction this year. And then we think it's going to be followed by a return to growth. That this slowdown into what the Fed's doing in March, maybe it's June, but it's looking more like March here. And then interest rates rising. It's just a good time to see the market kind of have a quick little reset. Yeah. And maybe we just go sideways and drift a little bit lower. But we think it's going to be setting up a better economic backdrop to reaccelerate as we progress through 2022, get to the back half of the year. So our action plan for 22 is defense first. We talked about our rotation to staples utilities, our overweight healthcare, our first position international in quite some time. Make sure we have our full gold positions, and really keeping those cheap, boring blue chips, which did okay last year, not quite as well as some of the FANG names and the growth stocks, but you're seeing them start to do their job early here. It's only 19 days in, but really do their job here early in 2022. We're very, very excited about. I mean, those are cheap valuations. They pay dividends. They're boring, but they're not boring in a year like this, where we really use them for stability, for lowering our risk of the portfolio. Energy, we talked about it 2 or 3 times now in this presentation. Best performing sector last year. We were overweight energy last year. We trimmed that into the first 3 weeks of the year here, as it's the best performing sector again. We went from overweight, now we're at market weight. We trimmed our financial exposure for a host of reasons. We came into this year and will remain most likely for the first half, but at least the first quarter, barring a correction faster than that, we'll be underweight tech, and we're underweight FANG. The FANG baseball, Apple, Amazon, Netflix, and Google, I believe are 24.7%, right around there. It might have changed in the last week. And so we're way underweight that against the S&P. But we're still holding our core names there. Great investments long term. Their valuations are a little bit higher than we'd like to see on some of those. So we're just going to remain underweight. And if they pull back and if the market does its corrective action that we expect, it'd be great buying opportunities. So we want to make sure we're positioned to take advantage of that. So we're really looking at as defense first, and really at the midway point. Maybe it'll be sooner, maybe it'll be a little after that. As always, we'll be super dynamic in what we're looking at in the economy, the map, everything. In the second year, we're really looking second part of the year, looking forward to reversing the defensive sector, reversing more of the boring blue chips, and getting aggressive more on the growth side if it permits. If the Fed does its thing and the economy rebounds. So that's our 22 action plan.
So yeah. I mean, just to sum it up, I mean, we expect the volatility. We've already seen a lot of it. We think it's going to continue for most of this year. It's sort of our sense that we're pinging around low levels from December that are being tested right now here in January, and we could see this holding and then an oversold bounce into the end of the month, maybe early February. At that point in time, we'll probably take some more money off the table and get even more defensive, build our cash position for what could be a deeper sell-off. The S&P's down 4%, and the Nasdaq's down 10% from the side, so it's obviously already in correction territory. And we just want to hunker down and play defense to get through the first half of the year, which would set up a great opportunity to get more aggressive and growthy type names. But we still love dividends, and we want to keep those boring blue chips because they serve a purpose always in our portfolios. And we could see having an international exposure for a number of years. That's not just that for the next 6 months. It just seems like they have not participated in the market like our markets have, and that they're just more attractive for the long-term investment for the decade ahead. So we expect, like a roller coaster, and for us, we're just going to ride that and play defense, which leads me to this slide. And I really feel for this guy. He's coming, looking for a job, driver wanted to apply here. And he's looking, he's like, I used to be a stockbroker, but I'm looking for a gig a little easier on the stomach. And you can see that roller coaster behind. And that's what it feels like. But that's, we're used to volatility. The market takes the escalator up and the elevator down. That's the market way. But, we think that getting through the rough patch, just like every correction we've seen in our career, it's healthy. It's not fun, but it gets us to a better place. And that's just our focus. We haven't seen a 10% sell off in quite some time. We're overdue, and we're going to play defense, and we're positioned in areas we think are going to do quite well to weather the storm. But looking beyond the now, things look pretty attractive, into 2023 and 2024. We just have to get through this reset. And, the big risk, I think, is the Fed doing another, policy mistake. And if they're not paying attention to what the bond market is telling, that could be a problem. And at that point in time, we will switch gears and get really aggressive to defend the portfolio too. Yeah. All right. Well, thank you so much. We do have some questions. I know some were submitted earlier during the registration, and then I see on the Q&A there's a handful. So let me just take these. One question: do you recommend any REITs at this time? We actually do own REITs.
They're more of a real asset. And I think the price appreciation that we've seen is unlikely to continue at the rapid pace that it has. But REITs are all encompassing, from hospitality, healthcare, to obviously commercial properties, and then residential apartment buildings. So it depends what you're talking about. We just like the broad diversification, because the pricing in commercial office space has obviously come down because the demand is not going to come out the other side like it was a year and a half ago, 2 years ago.
Right.
So, but no, as a real asset, with valuations where they are, REITs definitely make sense.
Is it foolish to invest in bonds or bond funds at a time when bond rates will be rising? Okay, so we touched on that. Yeah, I mean, it's basically why we stayed away from the bond market for fresh money last year. Even though we think long-term interest rates are going to continue to go higher, that will be healthy. That this 40-year bond bull market has come to an end. There's going to be cycles, and that's why we're seeing value for 2022 in the bond market that might be more short-term oriented. What impact if Omicron, the variant, continues through much of 2022? So that's a really interesting question. So far, we're seeing that Omicron is much more virulent, so it's more contagious, it's spreading faster. But so far, it looks like for the vaccinated, it's not as big of an issue. Unvaccinated are being hospitalized. But what we saw in South Africa, where it started, and then the UK, it's crested, right? And there's reason to believe that that's happening in the US on the East Coast, and maybe peaking, cases peaking out west here, maybe this week. I guess the big issue is lockdowns. China's locking down again, so that is playing a huge role in economic activity. China is the second largest economy. They're the largest trading partner for Europe. So Europe is certainly subject to China economically, and China's rate of growth is slowing significantly. They grew 8% last year. They might be lucky to grow 5% this year. Here in the US, I think it's psychology. If it's continuing to spread, people will feel less comfortable getting out and about, and the reopening of America will just be, continue to push out. But living with COVID seems to be the theme, and all indications are, that we get past this, in the spring and summer. And I don't know. I mean, I think the American people are ready to spring breaks and summer vacations, and airlines and hotel stocks are suggesting that is a brighter pasture ahead.
And if the Delta economic data was any indication to what we're going to get from Omicron, which is less lethal as it's coming out of Omicron, that the dining rates, for instance, with Delta, which seemed to obviously was more lethal than Omicron, spiked almost right away when it started to dissipate a little bit. I mean, people were not afraid to go out to dinner. Hotel occupancy really started to pick up as well. So if Omicron stays on this more mild spectrum, I think that we expect much the similar as what we saw last year. Like I said, pent-up demand.
Yeah.
You know, we've got 2 years into this almost. I mean, it's COVID fatigue for a lot of people. You know, we were laughing this morning just coming here and doing the presentation. It's fun to, like, we miss you guys as clients. We like looking people in the eye and smiling and having conversations and human. So I'm really hopeful that Omicron can stay to be more on the mild side. Obviously, the case is concerned, but I said we can just live with this. I think that it's not going to impact the rate of growth, much like what the Fed would do or something else. Just kind of want to see what they do.
But the American people are spending clearly, and it started off, stay at home, do remodel, find appliances, new devices, certainly purchases online. The second stage of the recovery is reopening and buying services and travel and experiences. Yeah, durable, versus services. So that's really important. Will it rain anymore this year? Yes, it's going to rain in February. I don't think it's going to rain the rest of January, but it's going to rain in February. That's my prediction. What can we do to help your team be most successful on our behalf? Wow, that's a really nice question. You're doing it. I tell my team all the time, we're in the business of life, and we're ready for anything that comes our way. But I feel like we're in this together, and we share information and we act on your behalf, and you keep us posted on what's going on in your lives. You're our why, so keep doing that. Thank you for that question. How do I make money in the market in 2022? Well, what we just outlined, I think simply put, boring blue chips.
Lower valuation, dividends,
totally.
Get through the bump and then look at playoffs.
Yeah, those are going to do probably the best, at least for the first half of the year, and maybe for the full year, even though tech might do better in the second half. Looks like we have some questions here.
Some questions. What is FANG in the last line of the previous? Yeah, so FANG is the slang for the abbreviation of the big mega cap names that are in the S&P 500. Stands for Facebook, Apple, Amazon, Netflix, and Google. Yeah, it's just
and sometimes people are putting M in there too for Microsoft. Yeah,
FANG M.
Great, FANG plus M. That's nice. Where do you see Bitcoin headed in 22? Well, you saw that roller coaster cartoon. It's down 40% from the highs. It seems to be basing at this level, but it's a risk asset. It's quite speculative. We think that there is, a place for cryptocurrencies long-term for sure. Where it happens short-term, it's anyone's guess, but it's going to stay volatile. But, it's our sense that, this high 30,000 level seems to be meeting with buyers. So we'll see, but we would not be surprised. If we see a bigger stock market sell-off, Bitcoin would go down too.
And of late, it's been more correlated to money supply, and money supply growth has been decelerating. We're actually going down the crest of money supply, which is obviously reckless fiscal spending.
Yeah.
When you go the other way, Bitcoin becomes more susceptible to the sell-off.
Okay, well, thank you so much for attending. I hope this was enlightening and helpful. We also try to make it interesting and fun. Keep those belts buckled. 2022 is going to be a roller coaster, and we're ready for it. We just gotta, survive the dips. Okay. So thank you, everyone.
Cheers. Happy New Year.